So, Mr. Orange Man is back with his tariffs again. So in today's video, I'll be covering the tariff portion as well as what stocks to look at their current prices. So for reference, this is my portfolio here. I update this weekly on the channel, so feel free to check it out. But for today's video, I'll be covering the tariff portion. So Trump is actually trying to threaten tariffs again on China because of the trade deal talks. And this actually came up because of your rare earths dispute. So China actually tightened export controls on a lot of your different rare earths. And your rare earths, they're important for the defense industry, for the chip industry, which is crucial for the Americans right now with this AI boom. So we're seeing rate across the board, a lot of stocks are down. So you're seeing Google down around 1.5%, you're seeing Amazon down more than 3%. And overall, this is a sell-off that has been long coming. The market has been going up and up and up over the past 1 to 2 months or so. And this is probably a time for the market to cool down a bit more. Also, if you were to look at the fear and greed index, the market is now nearing extreme fear again. So it's quite crazy that we're currently now closing on extreme fear because just 2 months ago we were at extreme greed. And then if you were to look at the other indicators as well, the market is currently fearful in terms of market momentum. Then you have stock price strength being down, you have stock price breadth being down. You have the VIX showing that we are in extreme fear again. So the VIX is currently now at around the 21, which is historically on the high side as well. So the market generally is currently in this fearful state, and we'll be covering some companies that look interesting as well today. So Amazon today is now around 3.5% to 4%, and this stock is actually flat year to date. So it's currently trading at a 33 times of earnings, and valuation wise, the company looks decent at today's price. So I actually added a bit to my Amazon position, not substantial, just a very small portion, but Amazon looks like the best buy right now in your Max 7 companies. And it is the one that is hit the most because it relies on China for a lot of its imports, for a lot of its inventory. So I think for me, what Trump is trying to do here is to try and gain leverage ahead of the talks that they're about to have in South Korea in about 2 weeks' time. So as usual, the markets probably think that this is Starco. And for Amazon, I think this is an overreaction as well, which was why I added a bit to this company. The next company that I'll be covering as well that's down quite a fair bit is Ferrari. So Ferrari year to date is now around 16%, currently trading at a 38 times of earnings. So for Ferrari, they actually released some of their guidance yesterday. So they had their capital markets day and they released all these guidances here. So if you're to look into the guidance, what they're projecting in terms of adjusted diluted EPS is around 5.5% CAGR from 2025 to 2030. And if you're to look at the valuation again, the valuation today is at around a 38 times of earnings. So paying a 38 times of earnings for this company growing at 5.5% is actually quite steep given today's valuation. So for Ferrari, although I think the company is high quality, it is a company that will stay around for many years because it is premium luxury. I don't think paying a 35 times earnings for this company growing at 5.5% is reasonable. And for me to want to look into this company, I would need it to drop to a low 30 times of earnings, maybe below 30 times earnings as well, for it to even look interesting. So that will be around $300 a share. FICO is another company that looks interesting today. So the stock is down around 10% over the past 5 days after a 21% surge in one single day. So the stock is currently trading at a 65 times of earnings. So this is actually an ex-post that I posted just a few days ago. So FICO is currently trading at a 64 times of earnings. So just some napkin numbers here. They have $632 million in trailing 12-month earnings. So they have around $632 million over the trailing 12 months. So assuming 70% of that comes from scores, which is, I think, a good estimate. And if it doubles its pricing in terms of the scores, that will be around a 1.7 times of its trailing 12-month earnings, meaning to say that net income will grow by around 70% next year. So the current PE is around 65 times. So assuming they increase their earnings by 70% next year, which is highly probable currently, the stock is currently trading at a forward PE of around 38 times. I think for FICO, the current valuation looks decent. I'll look to add into the company again once it reaches around $1,500 a share. That is when I'll increase my allocation to this company. I think the company has amazing growth in the next few years, and especially with this pricing model and especially with the company able to basically evade all the different credit bureaus, I think it's a decent opportunity if you're a long-term investor. And I think FICO's growth may be underappreciated by the markets. This is assuming no volume increase in your mortgage market. So we have to look to see what happens with FICO, but I'm bullish on this company. Next portion, I'll be covering some of the earnings next week as well. So next week, we'll have big earnings coming up. So besides the banks reporting on Monday as well as some on Tuesday, we have ASML. ASML is reporting earnings on Tuesday. And then on Wednesday, we have TSMC as well. Two of the bigger chip companies in the entire world reporting earnings next week. So for ASML, the stock is up around 35% year to date. It is one of my larger positions in my entire portfolio, and it has done very well for me. So the stock is currently trading at a 32 times of earnings, which I think is around fair for this company. So for ASML, it will likely be the beneficiary of all these different deals made here. So when you have OpenAI coming up with all these different deals, when you have Nvidia saying that the chip demand won't slow, this will all go back to TSMC as well as ASML. Because without ASML, you can't make so much chips. Without TSMC, you can't make the chips as well. So ASML will likely see a surge in terms of its earnings in the next few years. And based on the company's projection, even at today's price, the stock at its base case scenario is still around fair value or so. So I would say ASML is a decent company going into earnings. And the company has historically beat its earnings as well. So if you were to look at its earnings history over the years, although the earnings are quite cyclical because it's in the semiconductor industry, they generally beat a lot of their earnings. So Q2 of this year, this is because of the depreciation in the USD. But generally, ASML's management is quite good with their guidance as well as their earnings. The next company that is reporting as well next week is TSMC. So TSMC year to date is up a whopping 42%, currently trading at a 31 times of earnings. So for TSMC, they actually gave out their revenue report this year. So their revenue report showed a 31% year-on-year increase in terms of revenue compared to last year. So this is amazing earnings for this company, amazing growth for the company. And if this is only the start of this AI boom, then TSMC will definitely be one of the greatest beneficiary of this entire AI surge. So for TSMC on Thursday, it is probably one of the most important companies reporting earnings this year. I expect these two companies, TSMC as well as ASML, to both do well, given all the deals coming up, given all the deals that have been made. So for TSMC, this is an earnings that looks interesting on Thursday. Make sure to look out for this one. Last portion, I'll be covering some comments left in the comment section below. So the first one, it says 25% cash. Lol, come on Guan, that's too big. Unless you are also including your emergency funds in there, where I exclude it separately. Now you are stuck trying to buy into the market when it's overvalued. Yeah, there's a lot of confidence buyers as well as recency buyers. So the markets have been going up by quite a fair bit, and now people are getting a bit overconfident. I would say the markets today is expensive. I don't think buying into the markets today is something that I will continually do. I won't be plowing all my cash into the markets today, given its current valuations. I'll nibble here and there, but 25% cash is a position that I'm comfortable in. I'll be holding put and staying out of the markets unless the markets give me a decent opportunity over the next coming months. The next question, it says, "Hi Guan, great video. What's your thoughts on Salesforce? Thank you." So for Salesforce, I think the current narrative now that your software companies will be replaced is overblown. I think AI won't be able to replace them. It is ingrained in a lot of different companies. So if you work in a corporate world, if you speak to people that work in a corporate world, what they have told me is that Salesforce is irreplaceable. Salesforce is a software that the company cannot replace because of all the data, the high switching cost there. So for Salesforce, in that regard, I think the switching cost is high. I don't think AI will be able to replace them based on what I've asked about. But for Salesforce, I don't like the CEO, Mark Benioff. It feels like he's always trying to get on the good side of Wall Street. He's trying to chase all these acquisition deals. His capital allocation is something that I'm not a fan of. He buys a lot of different companies, pays a lot of money for them, raises a lot of debt, dilutes shareholders. That's not something that I like. I like companies that give back to shareholders. And if he didn't buy those companies and he gave back to shareholders, I think the stock now will be a lot higher than what its current price is. So while I think Salesforce is a decent company, I don't think it is particularly cheap. I don't like their CEO as well. So those two portions are why I don't like this company and I probably won't invest in it. I hope you guys have found this one useful and invest safe.